You introduced a volatility-based risk management approach while moving away from traditional equity and bond approaches. How has that been an advantage for your portfolio? Like, what kind of new opportunities has that opened up?
Yes, well, traditionally people look at, specifically on the bond side, and the thought was, you know, bonds are the safe asset, and
Hmm.
especially during, the ZIRP, the zero interest rate policy, long bonds, the long part of the curve was, extremely tight and low yielding. You 1.5, 2.5, let's say between tens and 30s, different yields. The When you look at the duration on those instruments, the long bond was trading about a 17 year duration, which for those of the members who are not really familiar how this works or what have you, but 1% interest rate move causes a 17% loss in the portfolio,
Hmm.
and it's it's very problematic when you look at something saying, that is a correct risk assumption. And with
Hmm.
my background, really looking at more of a VAR, kind of a value at risk scenario,
Hmm.
is really the way that I believe a fund should be managed. So
Hmm.
when we brought that to the attention of the board and tried to change, that measurement to, allow us to take more risk, but in a more effective way to
Hmm.
really classify the risk as what it is,
Hmm.
as opposed to just giving it this random, name as a bond.
Yeah, absolutely. And you recently announced your retirement. I would love to dive deeper into how you have retained and hired great staff. Like, what are a few factors allocators should keep in mind?
Well, having people come to Cheyenne, Wyoming is difficult if you are coming from Atlanta, Georgia, or New York City, or what have you. If you're not familiar with the Wyoming culture, the Wyoming weather, Wyoming wind, which is unbelievable, and being a third generation Wyomingite, um, I grew up and the wind really, it's just like, oh, this is the way it is. And then when you move, it's like, oh my gosh, everything, every place isn't like this. So, I think Wyoming is wonderful and beautiful, and that the nature and solitude of it is wonderful. But other people might look at it and go, oh my gosh, the nearest opera is miles away. So there are those issues. So the what I found is the best people who had some type of affinity or tying to this type of area, and just were naturally attracted to what we have to offer. And I find that's the best place to go. And
Hmm.
ideally, if we pull talent from the region, which would be like University of Wyoming,
Hmm.
CU Boulder, University of Denver, Colorado State University, University of Northern Colorado, even Utah, BYU, a lot of those areas in that area that have similar types of geography and so forth. It's beneficial. So
Hmm.
I tried to replicate what we had in New York, where you have some really highly skilled, intelligent people. We have 3 PhDs on the staff. And when I started, there was one person managing 19 billion, which is ludicrous. And we were
Hmm.
able to expand that out to where we are 10 now. And it's worked really well. The group that we have is exceptional. I'd stack them up with any fund out there. And I think our results have proven that.
Absolutely. That's amazing. And further till June 2025, what are your goals and plans for both your portfolio and your team?
Well, so the big thing is to to work with a headhunter,
Hmm.
to find a good CIO that is one, you know if you're not happy here, it's you're not going to stay here, so is happy with the area. If they're married with kids, to see they make sure they like the school, just all of the different check the boxes things that it would be a
Hmm.
good fit. And then the process of what we're doing. A lot of my job, unfortunately, is not dealing with the markets, which is what I love to do. But you
Hmm.
get pulled into so many different non-investment related meetings and legislative meetings and so forth, which you also need to have, much more of a, kind of an outgoing belief in, yeah, have interpersonal skills, be
Hmm.
able to speak with different people and understand our culture and our beliefs,
Hmm.
is really important.
Absolutely. And what are a few factors that you're looking for in the new CIO?
Well, a lot of them are already in by statute. So,
Hmm.
10 plus years of experience having managing, $500 million or more, various asset classes, managing funds internally.
Hmm.
That's one of the big things. About a third of our funds are managed internally. So having, just managing managers is not really, something that we're looking for.
Hmm.
And have, as I said, much more of a kind of extroverted personality and having strong interpersonal skills.
Absolutely. And by when do you plan to get somebody on board? Is it after you step down, or do you want to train that person? And are there going to be multiple CIOs for that matter?
No, no, there will just be the one CIO. And so ideally, they would start July 1st of next year.
Hmm.
And hopefully, that we would have that person hired, by sometime in the spring of next year to be able to, move, bring the family, all of the things that you would have, when you're moving across country or across town or whatever.
Absolutely. And like, has the process of interviewing people and looking for people started?
Oh, we're just doing the RFP now
Okay.
to find a headhunter to work with us.
Absolutely. That sounds great. And you have had experience and great returns within your hedge fund portfolio. What are the kind of opportunities do you think are the most attractive in the current environment, including both sectors and strategies?
Well, because our number one factor is highest risk adjusted returns. That's
Hmm.
basically what our title is to make sure that we have these very good risk adjusted returns. Um, our partner with the hedge fund group is GCM Grosvenor Capital Management
Yes.
out of Chicago. So they run. We don't have the ability internally to do the due diligence, go visit with the managers and so
Hmm.
forth. We use their platform. So
Hmm.
anyone wishing to get on the platform needs to go through Grosvenor, and they will the vet the funds and look for it. And so for the things that we're looking for, we have two different structures. It's called Grosvenor BNC. We have numerous different, kind of structures within the Grosvenor platform. But what we do is Grosvenor, I would say, is probably more conservative in their hedge fund allocation, and it's kind of split 2/3, 1/3. We have 2/3 is managed by myself, and the other third would be Grosvenor. But they're more diversified.
Hmm.
They do not take as big of bets on kind of, I would say intermediate type moves where that's something that I do. So when
Hmm.
I see, I classify that as a kind of a 1 to 3 year, um, more of a cyclical or secular, type of event, then I will tweak the fund to kind of hopefully achieve a better return in that structure versus
Hmm.
the HFRI index. And
Hmm.
so, presently we're looking at it, and as valuation is extremely high, and it really
Hmm.
doesn't matter whether you're looking at equity valuations or investment grade spreads, bank loans, CLOs across the board. Um, the the spreads are extremely tight. So you've
Hmm.
had a tremendous risk on rally.
Hmm.
And historically, that has led to suboptimal returns over a 10-year period on the equity
Hmm.
side. And
Hmm.
any type of hiccup that you have in the equity markets or recession, et cetera, spreads
Hmm.
wide. So the index is about a zero point 0.3 beta to the
Hmm.
S&P,
Hmm.
and my fund is like 0.003 right now. So I have very, very little beta, the equity market, because the equity market is expensive. And
Yeah.
I don't know when we're going to see a correction, but I feel highly confident that we will see a correction at some point. And so, I'm not, I do not want to have that risk. And I do have outliers and some other things in there, but
Hmm.
there's some other things, whether it's kind of um, like on the credit spectrum or long short, both equity and fixed income, that
Hmm.
I think in this period when you're seeing volatility go up, especially in the fixed income market, when volatility, i.e. the move index is really, really popped up, it's come down, but there's some opportunity sets there now that
Hmm.
we're off the zero interest rate policy. So I would move, some of the funds into those sectors.
Yeah, that sounds great. And your portfolio also reflected that you're an internal diversified hedge fund. Could you dive deeper into how that works?
So within the Grosvenor platform, there are certain structures or funds that I
Hmm.
really enjoy, what their attributes would be. So, for instance, I reduced a lot of the long only equity managers, hence my lower beta. And for instance, I put in a very large investment into a fund called Concordia, which is a
Hmm.
long short. This is just one example,
Yeah.
but 10% of our fund, it's our largest holding, is with Concordia.
Hmm.
And the reason that I really like Concordia is because they're taking advantage of the basis differential globally. So the basis is very wide. So the risk, they're levered, but the risk is much more not directional risk, but it's liquidity risk, counterparty risk,
Hmm.
refinancing risk, and they're very good at trying to attenuate all of those markets. So not only will they say, okay, well, the 10-year basis is rich or cheap in U.S., Japan, Germany, et cetera, but they'll say, okay, well, we're going to do a butterfly around those rich and
Hmm.
cheap areas. So
Hmm.
you could see the basis come in or widen or whatever. You're just specifying or really taking one component, and you might be long the basis in one country and short the basis in another. So
Hmm.
it's kind of um, one of those instances where we really like the risk adjusted profile on it,
Hmm.
um, that they're able to achieve. I just think they're very good managers, and I've known them for many, many years. So, then you can look at some of these other kind of multi-strat global macro funds who historically have done very well in stressed environments. So if
Hmm.
there's a high probability that nirvana will not last forever, and this
Hmm.
Goldilocks scenario that the markets are priced for now
Hmm.
will not last. So, that if you look at the strategist or whatever, they'll tell you, that it's either like a 60 or 65% probability that we're going to enter into this kind of slow growth or Goldilocks period, I call it, or what have you, that the Fed achieves a soft landing. And yet we
Hmm.
know that the Fed has only achieved a soft landing one time in the kind of 95 period.
Hmm.
And so it's very difficult to do. And I'm not saying that they can't, but that's what the market probabilities are. And yet the market pricing is priced,
Hmm.
for a 90 odd percent probability of this happening. So I think there's a disconnect between what the market is priced for versus probabilities. And then also, just exogenous events. When you're this expensive across these asset classes, any type of exogenous event can really cause a steep decline in these very richly valued assets. So I would much prefer to not be involved in that. And
Hmm.
the cost to go up the credit curve, um, or kind of the capital stack arbitrage, going from the very low equity ask into a AAA security is very low. So we have been gravitating into very low levered funds, higher quality, just moving the portfolio. So where we're at risk is for a large expansion of the Goldilocks, and if we saw a very rapid upward trajectory in
Hmm.
equities slash further tightening of credit spreads, et cetera, then we would underperform most of our indices across the board because
Hmm.
we have the opposite bet going on.
Absolutely. And selecting managers for hedge fund allocations can be very tricky. So, how should one get through the board? Like, what are your suggestions? Selecting the manager and also getting approved from the board.
You'd need to go through Grosvenor because we use their platform. So the managers need to talk to Grosvenor Capital in Chicago and say, "Hey,
Hmm.
we'd love to get on your platform."
All
And
right.
that's
Okay.
and that's something that I would highly recommend to all of your customers. Instead of going directly to the manager, some
Hmm.
people might do this, but we do not. I
Yeah.
don't look at managers directly. It's they shouldn't call us; we'll call them.
Yeah.
But also go to the consultants, go to these type of platforms and show how your performance is. And so what we do is, if we're going into a private credit fund,
Hmm.
we're going to look at, we're only looking for low levered funds. We think that this is another one of those instances of risk in the highly levered private credit. There's a lot of money that's gone into these sectors. So historically, if you look at it, the companies that are in the very small area,
Hmm.
small capitalized, less than 100 million, let's say, in cash flow, that is the area that has performed poorly
Hmm.
in in a recessionary environment. And it's same thing like the small caps and stocks. 42% of them are not cash flowing positive. So, and that's in this period. What happens if things slow? So
Hmm.
that's the risk adjusted return that we're kind of looking at. But we will, go across the spectrum and we try to find the best managers. We have all of the services. As long as you have your returns, you have to meet years in the business. You have to be, at least 3 years, with very good returns, and usually we're looking for somebody with multiples of that, and
Hmm.
historically been able to perform across the spectrum. So for your readers, number one thing is to be in the top quartile of your sector. That's really what you're looking for. And as soon as you drop down into the lower quartiles, that's going to be, that's not something we would ever invest in.
Absolutely. And are there is there anything else that, allocators who are trying to grow their hedge fund portfolio should keep in mind?
Um, yeah, I just think that, coming from the hedge fund side before and managing a hedge fund is when you get into a situation where you're running with the crowd, it becomes a very, very dangerous situation. And then you have a tendency to increase leverage when things are positive, and
Hmm.
that's where you get into trouble. So, stay with what has treated you well over the years. As soon as you start to deviate that's a big red flag. You realize what's out there and stick to what you're very good at. Because if you said, well, we did this type of structure for this time, and then kind of things change, so now we're moving to this.
Hmm.
That's not somebody that we've ever invested in. It's somebody who has a very strong niche in one area that they feel very confident at,
Hmm.
and exploits that area and has been doing it for a very long time with a high success rate.
Absolutely. And most managers, especially in the current times, are offering credit. However, I would love to know what kind of strategies and sectors within private credit do you find attractive, and what does risk in the space look like for you?
Well, as I mentioned, there's so much money going into it,
Yeah.
that you're really seeing the risk is with these highly levered funds,
Hmm.
that are invested in low capitalized countries that have uh, very very tight, or covenant light
Hmm.
type of structures. And when the market moves, or funding rates stayed higher than anticipated, those companies will struggle. And
Hmm.
as you know, leverage is wonderful on the way up and is terrible on the way down.
Hmm.
So we'd prefer in these very expensive times, when
Hmm.
bank loans and some of these credit structures are expensive, to be in the very low levered part of the stack,
Hmm.
with a higher capital base, so they have more options of refinancing.
And what is that? The lower stack.
Well, as I mentioned before, when you're below 100 million, those type of companies have struggled in the past when you have any type of stress or
Hmm.
recessionary periods. And I'm not saying we're going into recession, but
Yeah.
if the market is saying two-thirds, a third, or what have you, I actually think it's higher than that, just because of the amount of money that's in there in some of these structures that we have, that you could see, even idiosyncratic risks come into the market that would hurt these type of structures. So we could continue to stay where we are with new highs in stocks and so forth. But if rates stay this high, then you're going to have all kinds of just further issues with people
Hmm.
who are highly levered. They in, incurred leverage at lower rates, and they have been extending their debt maturities. But at some point, you can't extend and pretend forever.
Hmm.
You have to restructure or do something different. So unless rates go down significantly to bail them out without a recession, then some of these
Hmm.
companies will struggle, just because of the nature of their business.
Hmm, absolutely. And what are a few trends you anticipate in the coming months that might impact your portfolio? And how have your allocations changed since identifying them?
Well, as I mentioned before, we're very conservative in our
Hmm.
structure. So we are looking for more volatility to increase. So like when vol was trading, with a 12 and 13 handle the VIX,
Hmm.
those are certain things that were. If you look historically, it doesn't typically stay at that level for very
Hmm.
long. So those are types of things where we put on structures where we look for volatility to increase, funds that do better with higher volatility. Um, the long end of the US Treasury curve, I think, is going to be problematic because of our debt levels.
Hmm.
So, regardless of who the president is, it's projected that under either candidate, our debt levels will exceed 130 to 140% in the
Hmm.
near term. And I know with a twin deficit country like the United States, we don't have the ability to finance ourselves like Japan does, who has much
Hmm.
higher debt levels. So we're at the whim of the market, and if the bond vigilantes come into play, which I can't believe they won't over some period, then
Hmm.
we're going to have a problem with our economy, and the debt payment levels that are already surpassed um, our military and defense budget will become more and more problematic. So those are the
Absolutely.
issues that we see
Hmm.
under any presidential candidate, that
Hmm.
volatility will increase under either one, and volatility should increase under either candidate, from the very low 11, 12% that we saw, 13%, and that the long end of the treasury curve could be under pressure because of on relative basis because of our very large debt load.
Absolutely. And how do you think elections are going to impact private markets?
Well, it depends under each scenario. So we've mapped out probability wise, and you look at a red sweep, blue sweep, which I think is very unlikely. And then under Vice President Harris's views versus former President Trump's views of what they want to do and implement,
Hmm.
it's a certain path. Each one of them has a different view. So there's way too many, variables. You say, okay, Trump presidency, blue house, red senate, you go through each one of the variables and the decision trees will come out. But you look at it and it's, historically speaking, when you have polls this tight, the margin of error is so tight that it it is just randomness, and that no one
Hmm.
can really accurately predict. If you're looking at the polls, I think is a fool's errand to spend time on that, because when you're this tight, no one knows. And
Yeah.
so instead, you look at the scenarios of when you do your decision trees and saying, okay, well, what will happen under either scenario or all scenarios? And it's just varying degrees
Hmm.
of how much more debt we're putting on. But that's the number one factor of this analysis, is that debt levels will increase until some sanity comes into the market, saying that we cannot expand in perpetuity. And if that happens, um, there's going to be a real problem for our financial markets, because foreigners who support our debt level with our twin deficits that I mentioned will demand a higher premium
Hmm.
onto our fixed income, which will crowd out other investments. There's all kinds of you know negative impacts of that kind of scenario. So that is really, and it's much more of a function of the long end than the short end. And so
Hmm.
that's really the outcome that we're focusing on, is what would higher debt do to the various asset classes, the economy,
Hmm.
etc.
And are you making any allocations per se to kind of combat the effects of it?
Well, the big thing is shortening up from our
Hmm.
30-year allocation. You come down into the belly part of the curve, that is more advantageous. Um,
Hmm.
you know, Reducing exposure to riskier bank loans or what have you, and moving up the credit spectrum. Moving out of very, very tight um, investment grade credit spreads
Hmm.
into mortgage-backed securities or whatever, that are still tight, but not on historical tights, that historically have done much better in
Hmm.
that 1/3 negative scenario or what have you. So all it is you're just kind of looking at the odds and trying to position a portfolio that
Hmm.
has the best risk adjusted advantage
Hmm.
of what the forwards are forecasting. Because if we meet the forwards, theoretically the market should move, right? So we
Yeah.
have to identify where the forwards, in our view, are mispriced, and structure the portfolio accordingly.
Absolutely. And within your fund and private equity portfolio, how do your allocations to AI look like? Like you could dive deeper into the sectors and strategies you're eyeing. And also, do you plan to incorporate AI into your decision making?
So we've done kind of a deep dive on it to try and find out where we could find AI advantages. And when you really look at it, it's still yet to be determined, the winners and the losers from the AI.
Yeah.
And as far as the companies and so forth, we don't make company specific bets. We do sector
Hmm.
bets. And so, would you say the Nasdaq would outperform the S&P, et cetera? So those
Yeah.
are the types of things that we look at. But when you really look at the amount of money that's come into it, one of our managers who manages a very, very large pool of money.
Yeah.
A year ago, they were banking. This is a banking company that finances these companies. A year ago, they had zero customers with AI in their name. A
Hmm.
year later, they have 25
Wow.
with $6 billion market value.
Wow.
So when you see those type of things, it's
Hmm.
not smart enough to pick the winners and losers of that. I'd
Yeah.
rather try and take the big picture. And what we found is incorporating a very complex AI structure into the investment process. At this time, there are other people like our large money managers who've spent, millions and millions and millions
Hmm.
of money doing this. We'd rather have them incorporate it and try to help them with their investment decisions. And what we're
Hmm.
doing is using it much more in the generative AI and some of the different types of uses that we can use in just basic presentations and our scenario analysis and so forth. That is not necessarily predictive in value, but helping us in our work to
Yeah.
reduce the amount of work that we spend on common systems and programs that we're using.
Yeah, absolutely. And what kind of sectors do you anticipate to grow within AI? Or like what sectors do you find attractive? Any underlying as well?
Well, there's it's a whole litany of different things, but when you're
Mhm.
looking at different areas, like call centers, is a great
Hmm.
example. So many of these companies now have call centers that you can click on and say, okay, well, this would be an area that you think could be disintermediated.
Hmm.
And so then you say, okay, where are the large call centers? For instance, India,
Hmm.
10% of their GDP has is correlated to call centers.
Hmm.
So will the Indian stock market um, perform as well as it has in the past when 10% of their GDP could be disintermediated? So
Yeah.
those are the types of things that we look at. It's not necessarily the first trade, but could be the second or third iteration that
Hmm.
we will move to take advantage of.
Amazing. And lastly, what are the biggest challenges that you're facing right now?
Uh, Really, managing with very expensive valuations.
Hmm.
So you're at a crossroads to where you don't want to be out of the market
Hmm.
because time and time again that timing the market is very difficult. So
Hmm.
what we try to do is tweak our exposure and go more heavier or lighter into certain areas. Um, but when everything is cheap,
Hmm.
it's much easier for us because we just look at valuation wise, project where we are forward, and you say, okay, well, we believe that the forwards are wrong,
Hmm.
that the economy will recover, that these companies will recover. That's the easier trade. The
Hmm.
harder trade is to say when these very expensive valuations um, will become more have a better relative valuation. And so the
Hmm.
timing on that, it can go longer than thought possible. I mean, I just look back into 1998, and I was looking valuations in the Nasdaq in the .com sector, and I thought, oh, this is extremely, excuse me, extremely expensive. This stuff will come down.
Hmm.
And being early is the same as being wrong. But you had, the Asian currency crisis, you had the Russian, blow up with their short-term financing and funding with their T-bills. They had all kinds of different issues, and yet we continue to motor on into the year 2000 before valuations and the Fed got involved, and we saw the correction. So being early is the same as being wrong, and so that is harder. So you try to, as I said, tweak it, and so we're extremely defensive in our portfolio, but you don't know, when it will happen or it's very
Hmm.
difficult. I'm not, Nassim Taleb and predicting black swans, but when you do see one, this is the time those exogenous facts or events really will have an outsized hit on these expensive valuations. And whether you're talking about Ukraine, Russia, China, Taiwan,
Hmm.
Israel, and the Middle East, you have all of these different things that could really magnify and cause issues. Those are
Hmm.
the known knowns. It's the unknowns that really keep you up at night. And so you say, well, if you already know these and they could clearly blow up, and if the Strait of Hormuz was affected, oil prices would be well above 100 instead of 67 or where we were this morning for TI. So those are the impacts that were just priced for perfection, and
Hmm.
historically that has not ended well.
Hmm. Absolutely. That absolutely makes sense. But I think those were all the questions I had for you today. But it was lovely talking to you, and I wish you all the best. And I'm sure
Well,
you're very excited.
yes, to do the next chapter and allow someone else to take the fun to the next level.